Hello and welcome to the Monday edition of Market Call Tonight. I'm Paul Waldy, and for the next half hour, Ron Ianieri of Options University will be answering your questions on energy exploration companies. To reach us with your questions, call toll-free at 1-877-667-6288. Or if you're in Toronto, dial us direct at 416-957-8199 or email us at marketcall@bnn.ca. Well, I know, Ron, welcome. I know you're going to talk about energy exploration, but just about any company involving an option or options with any company. I think that's what we're going to try and aim for tonight. But why don't we start with Ron? Tell us a little bit about, for the average investor out there watching, might not be all that familiar with options, how they might be able to use them in the portfolio. Take us through kind of an options 101 if you can.
Okay, well, obviously options are a very sophisticated product, a little more sophisticated than stocks, so there's a little more of a learning curve here. But what people have to really realize is that sometimes the extra time, effort, and energy spent in learning something is worth it. And you have to make that determination, and I very much feel that if an investor understood all the advantages options gave them, then they would say that, hey, this is well worth spending time, effort, and energy to learn how to use these things properly. When used properly, options are definitely much more cost efficient than the underlying security. They are actually less risky when used properly than the underlying security. They can help you generate income off of the securities you already own, and they can be used to protect the securities you already own. And one, I think, the most interesting things about options is that in the options market, you're able to lock in profits while maintaining the size of your position, which is something you just can't do when you're using an underlying, and it's something that all the analysts say that you should be doing, riding your winners. Right. And this little fact makes it so much easier to ride your winners in confidence.
Take us through a simple strategy, investment strategy that an average investor could do tomorrow if they wanted.
Well, basically, we have what's called calls and puts in options. Calls are a bullish instrument giving you the right to buy a specific stock at a certain time at a specified price. Now, that's obviously bullish because I would be able, for instance, if I wanted to buy IBM, because I thought IBM was going to $150. It's currently, say, trading at $100. I could buy the IBM 110 calls, for instance. What that's going to allow me to do is between now and the stated expiration of that option, and there's many different expiration cycles, between now and that expiration in the future, I have the right, but not the obligation, to buy IBM for $110 a share. Now, obviously, if IBM stays here and is trading at $100 a share, I don't have to exercise my right. So whatever I spent on owning the option, I lose, which is far better than actually owning the stock, which accidentally could open at $50, and I would have that huge loss.
Because the option is priced at a fraction of the $100, right?
That is exactly right. That's where the cost efficiency comes in. But let's just say that by the time expiration's coming along, I was right, and IBM has traded up to, say, $150. By me having the right to buy the shares at $110 right now, in theory, mechanically, I could exercise my option, purchase the shares at $110, and then sell them on the open market for $150. That would give me a $40 profit minus what I spent to purchase the option. Now, obviously, for those of you who know options, know you don't have to go through that whole mechanism. The option itself will now have a value that you could sell out for, but it's something that helps an individual investor with a smaller account get best use of their money that is in the account, best bang for their buck, in a very, very safe way. Because
the value of the option obviously goes up as you get closer to that $110 amount, right?
Well, that is correct. Think about it. If the stock is trading at $150 and I own the 110 calls, those calls have to be worth at least $40. Reason being, I would be able, if I bought that call from you, I would be able, that call's got to be worth $40 because the 110 call gives me the right to buy it at 110. while it's trading at 150.
Right.
So now we know that that has to have at least $40 of value, because that would be the innate value of that call, what we call the intrinsic value.
Right. Okay.
So for someone that's trading the stock right now, if they decided, hey, I don't know if I want to trade an option, but the idea of using an option is appealing, this is the type of stock trade, or excuse me, the type of option trade you would make, which we call stock replacement, using the option in place of the stock position.
Okay, and we gotta take a quick break momentarily. But of course, put options are just the opposite. That's an option to sell a stock. So that would be more of a bearish thing, where if you think a stock is going to go down, you'd play the put side of the equation. Same mechanics, just the opposite, right?
You said that perfectly. So many people are comfortable with calls but afraid of puts. Just think of it this way. All a put is a call in the other direction. The mechanics are identical. They work the same way, except one gives you the right to buy, which is bullish, which is the call. The other gives you the right to sell, bearish, which is the put.
Okay. All right. Stay with us. We'll get to some of your calls and emails for Ron Ianieri. That's next. Back to Market Call tonight. Paul Welty joined by Ron Ianieri, Chief Options Strategist and co-founder of Options University. We are sort of doing a refresher course on options and how investors can use them in their portfolio. Let's go to the phones now. Jim in Abbotsford, BC. Go ahead, Jim.
Hi, Ron. My question is about Fannie Mae and Freddie Mac, and I am very interested because of what you said about Merrill Lynch, and you never got a chance to finish.
I cut him off.
Comment on Merrill Lynch, but nonetheless, it's Fannie and Freddie that I'm particularly concerned with, and I'd like to know if you think those stocks are good value at these levels. Thank you.
Thanks. And I should mention that Ron was talking about Merrill Lynch before we unfortunately had to cut him off for time just before the show started. So why don't you pick up where you left off, Ron? Tell us about Merrill Lynch, and if you can stray into Fannie and Freddie, give us your thoughts on that as well.
No problem. Like I said, Merrill has made a decision here by selling off their assets, a lot of assets, most notably recently, I think they sold off their stake in Bloomberg. They've done a lot of things here to make themselves smaller because they need to raise cash to pay off debts. So right now, Merrill is shrinking. Like most of the U.S. investment banks and financial services, they are shrinking. My concern here is that we don't really know how this subprime debt is going to shake out. We don't know if subprime debt is really worth 10 cents on the dollar, 20 cents on the dollar, 50 cents on the dollar. By selling out all of your subprime debt and getting rid of all those assets right now,